Welcome to the Personal Pension Radio Podcast, where you get unconventional insights into wealth building and retirement that actually work. Discover data-driven strategies and learn from a wealth of experience so that you can take your retirement to the next level. Now, here's your host. He was once bitten by a harbor seal, the income engineer, Kraig Strom.
Okay, we are back on Personal Pension Radio. Check out personalpensionradio.com. Just to recap for those who are new to the show and those who haven't heard it in a while, what's Personal Pension Radio all about? When you think about it, the death of private pensions, way back when most Americans working had a pension to look forward to. They had some form of guaranteed income that wasn't just Social Security. And speaking of Social Security, over time, Social Security has not kept up with the cost of living and inflation, etc. And when you add that together, the death of private pensions, the devaluation of Social Security, and other factors such as inflation and increased taxes, America, the U.S., is in a retirement crisis. So without the help of qualified advisors, and it doesn't have to be me, it doesn't have to be the team here at Personal Pension Radio, because there's lots of qualified advisors out there, but that's the key word, qualified, licensed advisors. It's a great time to mention, don't take advice for people you hear on the radio or even on a podcast like this. Although I am licensed as a certified financial planner professional, I'm licensed by the state that I work in, as well as many other states around the country, regulated by the Securities and Exchange Commission and FINRA and all of these various regulatory bodies. You really don't want to take advice from someone that you have not sat down with to really go over your situation in detail. So Personal Pension Radio is a show focused on bringing together the information that you need to help put things in perspective, to help you build and protect wealth and preserve your lifestyle today and in retirement, and even to send that knowledge generationally into the future. So there you go. That's a little bit about Personal Pension Radio. We are broadcasting from Mr. Foley's van down by the river, an undisclosed location down by the river, just so that we can keep things new and fresh. So the first segment I actually want to jump right into is actually from a listener. It was a question from Dan, and Dan had asked, once we get a savings plan, the balance achieved in our savings going forward for retirement and that long-term perspective, what's next? So I thought this would be a good opportunity to actually go through the steps that we recommend when it comes to building your financial castle, your financial house. And this is an analogy, a story that I haven't shared in a while here on the podcast, so I thought it'd be a good idea to go over it again today. So let's go through that. And then we'll switch it up today, and we'll cover some advice that's out there in the news and out there that just want to keep you abreast of this information, kind of make you stop and ask questions. Don't just take what you hear on the radio for granted. Want to make sure that you've got some perspective. So I'm going to switch it up and actually jump right into the first part here with a listener question. So let's go through the building the financial castle discussion. The first step in building any financial castle, and if you think back, in the olden days when the wealthy would build their castles, the very first thing they would do, of course, is build in protection. They would build in protection around those castles, whether it be a moat, whether it be high walls, whether it be thick walls and, with hot oil, burning oil at the top and lookouts and guards. And when we think about it, why did they do that? Well, the wealthy of old would keep their riches, if you will, inside their castles, their strongholds. And they didn't have Allstate and big insurance companies back then to protect their wealth and their assets, so they had to protect it themselves. So today, we of course have all of those protections available to us in the form of big insurance companies and other types of things. So when we talk about protecting the castle, that's the first step in any retirement plan. If you're, and this is my opinion, I have to be careful to specify this is my opinion. If you're talking to somebody about retirement planning or an investment plan, whatever it might be, and the first conversation you have is not about your protection, something's wrong. There's just something not right, because you've got to build from a position of security, of protection. So when we talk about protection, we're talking about car insurance. Car insurance is the most overlooked hole in the financial protection that we look at in most situations. We drive around, we're told on television by the lizard on TV that we can save 25% on our car insurance. Really, do we really want to save 25%, or do we want to make sure that we have the best possible protection? Because if you get into an accident at the grocery store, or you get into an accident that's just, they happen. Accidents happen, right? If your car insurance is not right, your other assets are financially vulnerable. So make sure that you're not hunting for cheap car insurance. Make sure that you're finding ways to design your car insurance so that it provides the most protection possible for the most efficient price. That's the way we usually will look at it. The same thing goes for your home insurance. A great example, this actually happened to someone that I know, that they had a situation where someone slipped and fell on their front porch after a rain. Somebody slipped and fell. That person filed a workers' compensation claim with their employer. The homeowner, my friend, didn't know that a workers' compensation claim had been filed until they were served by the legal department at the United States Postal Service. The U.S. postal carrier fell down, claimed that they fell down on the front porch, no witnesses, and that individual filed a work comp claim. And none other than the United States Postal Service came after my friends for lost wages and expenses related to this work comp claim. You can imagine how scary that might have been. It's almost as bad as getting a letter from the IRS. But thankfully, they had very good homeowners insurance. Their liability limits were very high. And that's a key thing. With very high liability limits, the homeowner's insurance company has a strong incentive to defend the claim. If you have minimal and very low liability limits, the insurance company has a limited amount of risk. So the higher the liability limits that you have on your car and your home, the more incentive the insurance company has to defend your claim. Now, on top of that, add umbrella liability insurance. If you do not have umbrella liability insurance, I'll give you a quick example here in California, where I'm recording this, down by the river in Mr. Foley's van. If you are found guilty in a civil court of some accident or something that is found to be your fault, or could have been one of your kids that was at fault, if you're found guilty in a civil court, they can actually file a judgment against you in California to garnish as much as 30% of your wages for a decade. 30% of your wages for a decade if you don't have the assets to pay the claim, okay, the judgment. So the umbrella liability insurance, again, is another large financial or insurance shield around your financial castle, around your family financial castle. Okay, so make sure that you're focusing on that protection first. So car, home, basic liability. If you're running a business, don't scrimp on the insurance. That is not the place that you want to be looking for cheap insurance. You want to get this is again my opinion, I recommend getting the maximum insurance that you can get that makes sense for the most efficient price, meaning that you have your deductibles done right and things like that, okay? Now, from that point, we look at things like life insurance. Life insurance for protection is one of the biggest mistakes that I see in family financial protection conversations. Life insurance it's not about paying off mortgages. It's really about replacing a paycheck. So if someone were to die suddenly, we lose the paycheck that person was bringing in. Or if we have a non-working spouse at home, well, let me ask this question. I'm going to ask you, the listener, right? If something were to happen to your spouse and the funeral is on Friday, do you want to go back to work on Monday? Especially if you have children at home. If the funeral's on Friday, do you really want to go back to work on Monday? Of course not. Of course you don't. So get enough life insurance to cover the economic value of that person, husband and wife, and get enough so that you can do what you would actually want to do. Don't try and get the least amount of life insurance. That's just crazy. In my opinion, you get as much life insurance as you can that fits into your budget, of course, and you really should try and make your budget fit into the life insurance as much as you can. Okay, so I understand budgets can be tight, but the last place that you want to scrimp is on life insurance, because remember, life insurance covers the wages of the persons that are paying for all of the other insurances and all of the other benefits and perks around life, right? So make sure that you get enough life insurance so that you can actually do what you want if the worst happens. You don't want to go back to work on Monday. You need to have the financial resources so that you can choose not to go back to work on Monday. Now, life insurance. There are many different types of life insurance. I will bring this one piece up as we talk about the next form of insurance, which is disability insurance, chronic illness insurance. Remember, everything that you have, your vacation, your home insurance, your groceries, your car that you drive, all of that is covered by your paycheck, your ability to earn a living. And if your paycheck is not insured in some fashion, and I'm talking about disability insurance, then you need to call us. You need to go to Personal Pension Radio and ask for a disability consultation. Ask for a life insurance consultation. It's important. It's not something you should be doing on 1-800-LIFE insurance or disabilityinsurance.com. It's a personal conversation you should have with a qualified financial advisor, whether that's someone like us here at Personal Pension Radio or someone that you have in your area. You owe it to your family, you owe it to yourself. Make sure that your life and disability insurance is right. Now, this came up recently, and we're just in the protection area still, and I'm going to cover this twice because it came up with a client that had a conversation with, and we were talking about this very subject. And they had disclosed that they had paid down an enormous amount on their mortgage. So they had written a big check for their mortgage. And I had asked, great, did you have a mortgage burning party? And they said, no, we just paid it down. We didn't pay it off. And I said, well, why did you do that? What was the intent? Well, we'll be in a better position. We feel more secure having the mortgage paid down. They feel more secure having the mortgage paid down. They had perceived paying down their mortgage as a protection decision. So I asked a question. When is your next mortgage payment due? And he stopped and she said, well, next month. And when's the next one due? Well, next month. Okay. So if one of you gets sick or injured or something bad happens, how much of that money can you quickly and easily get back out of your house? Well, they said, well, none of it. Not easily. Right. So are you really more protected than you were before? Well, of course they realized no, they're not. So paying down your mortgage does not add to your protection. As a matter of fact, it actually puts you perhaps, depending on your situation, maybe in a bit more vulnerable position. Because if you're injured or something bad happens, trying to get that money back out of the house can be even more difficult. So protection first. Again, let me reiterate this. Gosh, I've heard it so many times. If you are having a conversation with someone about retirement, about investment planning, and no one has ever brought up the conversation of protection, if your investment advisor, financial professional, has not asked you about the status of your protection, you've got to seriously step back. Make sure that you're consulting with someone to go over that, because if you then start investing and you never had your protection right, you do not have the fence or the wall or the moat around your financial castle. You're vulnerable. You're vulnerable to any number of things that can happen around you. So once the protection is in place, the next step when building a strong castle is to build a strong foundation. So in the financial world, we look at the foundation as savings, cash on hand, actual money in the bank. And I hear so many times people say, I'm not earning a rate of return on my money that's in the bank. So what? The cash on hand is a powerful position to be in. If you are able to have that money available right away for emergencies or opportunities, that's a powerful position. And remember, when the financial world blew up, 2008, 9, and 10, the real estate world crashed. Well, the very powerful folks, or people who were in a very powerful position, were those who had cash, because the banks stopped lending freely. So those people with cash were in a very powerful position to be able to buy up real estate, right? So they may not have been making a very good rate of return on their savings in the months or years leading up to the financial collapse in 2008, but they were ready for the opportunity because they had the cash. They didn't have to wait to be able to go and get permission from a bank or get a loan. So cash on hand is a powerful position to be in. Now, don't lose sight of this one though. Pay down non-deductible, non-real estate type credit card debt, things like that. Paying down credit card debt that might be costing 10, 12, 15, 18% is a critical thing to take care of as soon as possible. Those credit cards that are racking up interest expenses should be paid down as soon as possible. And remember, pay down the highest interest rate card first. Highest interest rate card first gets all the attention. Everything else gets minimum payments. And then once you pay down that highest interest rate card, then you take all the money and you attack the next highest interest rate card. Okay? Now, while you're paying down credit card debt, don't lose sight of saving cash on hand. Don't put minimum amounts in saving just for the sake of putting extra payments into credit card debt. You still need to build, in my opinion, a secure cash on hand position. So once you've gotten credit card debt and you've got that non-essential type debt or non-deductible type debt paid down, there are other places that you can accumulate cash on hand. Things like cash value life insurance. Being careful to make sure that you have highly liquid designs in your cash value life insurance. So that's another place that you can then start building cash on hand, but don't get wrangled into the idea that cash value life insurance by itself is a great place to build up your savings or cash on hand. It should be only after you've built up actual cash in the bank. Okay? And a piece that I hear all the time, but investments, things that have risk, stocks, bonds, mutual funds, those do not equal liquidity. liquidity is money that's just available right away. I mean, when you look at a mutual fund or an investment and you're looking at it on a Friday night, well, that's not immediately liquid to you because you've got to wait for the stock market to open on Monday before you can liquidate it. And in the case of a mutual fund, it's not going to sell until the end of the day. So it's not a liquid asset. Okay. And once again, coming back to the story I shared when we were talking about protection, equity in your home is not liquidity. It is not liquidity. Remember what happens when you put money into your home. What is the only two ways that you can get that money back out? There's only two ways, and both of them require a pretty significant process. One of them, of course, you could sell the house, and that could take, we're going to sell our house here right now. We're going to sell it. That's could take months. So you could sell it, or you could refinance the house. But you have to actually go to the bank, fill out all the paperwork, and ask for a loan to get your equity out of your house. Somebody said this, and I forget who said it a long time ago. They said, if you have to ask permission, it's not your money. Isn't that what you're really doing when you go to the bank for a loan? You're actually asking permission to get your own money back out of your house. So my client who paid down their mortgage, they were thinking they were in a protection position, but some folks I hear pay down their mortgage because they think of it as part of their foundation. Well, cash on hand is liquidity. Equity in a home is not liquidity. Okay. Now, finally, once you've built strong protection, strong foundation, you're now free to build the walls and the roof and to grow the castle and to go up. And that's where we get into things like investments, grow a business, start a business. It's important when we think about investments to be open to the full scope of the investment world, but not to get distracted by the next shiny thing or something that is, that whole too good to be true. I'll tell you personally, I've had an experience years and years ago where I fell victim to that too good to be true investment opportunity. And sure enough, it wasn't. It was not. It was actually too good to be true, and it wasn't good. And so now I come from a perspective of, have to say I don't like the idea that I went through that, but it actually makes me, in what I think, it makes me a better at what I do today because I have that perspective of having been there on that too good to be true conversation. So when you're looking at investments, definitely look beyond just the typical 401k, IRA, stocks and bonds, but have a conversation with a financial professional who understands alternate types of investments, who understands those various things that can be out there from a self-directed perspective and so forth. Okay, so once you're in a protected, strong foundation position, you can now feel free to look at investments, perhaps start a business. Come at those types of decisions from a long-term perspective. And here was the best investment advice that I ever received, and I've never been able to put it together. Maybe it's a combination of advice that I've received over the years in education as far as choosing an investment. So the number one rule of choosing an investment is buy it cheap. Buy it on sale. Buy it at a low price. So I'll use, in this example, I'll use real estate as an example. Okay, so back in 2008 and 2009, the real estate world fell apart. Really was that leading indicator to the great crash of 2008. Well, real estate fell in value tremendously. So real estate at the time 2009 and 10 rolled around was cheap. It was on sale. That's the time to buy an investment. Now, fast forward to 2015, when this is being recorded, and real estate here in Southern California has risen up a great deal. It has actually gone up quite a bit. And that that bottom turned into a very nice run-up in real estate. And my wife and I were fortunate to be able to acquire real estate at the bottom of that real estate market a few years back, and we were in a strong position with our foundation. We had the ability to draw on cash on hand liquidity without having to take loans out on our current house to try and get equity and things like that. We were in a strong position to take advantage of the opportunity that happened with the recession. So now the real estate market has grown up and the increase has leveled off. We're now really reaching that higher point. I won't say that I know where the top of the real estate market is, but we're now reaching a point where it's not really rising as much anymore. So we're actually in the position where we're starting to sell out of our rental real estate. We really got fortunate. We acquired some good stuff at cheap prices. And then the second piece of advice when it comes to buying an investment that happens to work very well with real estate is to use other people's money whenever possible. So buy it cheap with other people's money. Now, in the case of real estate, of course, that's going to be things like a regular bank loan. Okay, but now in the case of a business investment, it would be great to have assets positioned in such a way that you could borrow from a financial institution using your money as collateral, but not using your own money. So an example of that would be having money inside a properly designed life insurance asset that allows you to borrow using your cash value as collateral, and you're able to borrow from a life insurance company without actually touching your own money. So that's a very specific conversation that I could go into a whole show just on that topic. But the piece that I want to cover is other people's money whenever possible. So buy it cheap with other people's money. If it's real estate, you want to buy it in a good location. If it's an investment, for example, whether it be some commodity or stock or mutual fund, good location might be translated into, that company is positioned right in a particular market, or that commodity is positioned as a highly sought after thing going forward. Okay. Now, the final piece on the best advice I ever got when it comes to investments is be prepared to sell. Be prepared to let go. That I've heard it on TV, I've heard it and read it in books, I've seen this I don't know how many places. Bulls make money in the stock market, in investments. Bears make money in the stock market, in the investment world. Pigs get slaughtered. Okay? It's just a great way to say that don't be afraid to take some of your gain, some of your profits off the table and keep those profits safe. Okay, so the best advice that I've ever received when it comes to investment is buy it cheap. Number one rule. I mean, if you're looking at something like the stock market, well, you just take a look at it for the last 5 years and see where it went. I mean, is the stock market really as cheap as you think it might be? If it's not, maybe the stock market is not the place you want to be. But you look at some other investment that you really are interested in. Is it on sale? Is it cheap? That might be your first indicator that that's a good place to be. Could you buy it with other people's money? That's entirely possible. We are excited about that conversation. We love to teach on that topic. It's something that you really need to have personalized for you. So go to Personal Pension Radio and request a consult or contact us if you want to talk about that. And then good location, good market positioning. And then finally, be prepared to sell. So there you go. That's the segment on building your financial castle. That great question from Dan, one of our listeners. Really appreciate the question. Strong protection. Make sure that you get the protection right. Don't leave any holes in the fence. build a very strong foundation so that you're ready for opportunities. Then you start putting the walls and the roof up. You start investing, maybe starting a business. You look at it from a long-term perspective. And great place to be. Now, I want to move on to the next segment as we wrap up the show here today. This is one we call Watch Your Step. So the article I want to reference is actually from thestreet.com. I'm going to link to it in the show notes. You can get that at personalpensionradio.com. You can get the show notes there with every one of our episodes. Once they're all transcribed, they're linked to the podcast on the website. But this is from thestreet.com that just actually came out recently. The article headline is Boosting Retirement Income, How to Generate Funds in Your Golden Years. And this is... I about fell out of my chair when I'm reading this one section. First, they start out, one of the pieces of advice they give is stretch out your mortgage. If you end up in retirement with a mortgage, well, it's not great, but that's okay. Just stretch it out for as long as possible. Like get into retirement and go get a 30-year mortgage so that you can get the lowest possible payment. Now, whether you like it or not, they don't even mention a reverse mortgage in there. They don't mention a reverse mortgage as an option. They say retirement is all about cash flow. Well, if it's all about cash flow, then you've got to consider things like a reverse mortgage. Again, it's not a conversation today or a discussion about reverse mortgage, but the fact that they don't even include it in this article that's all about boosting retirement income is just, I think, it's just a huge oversight on their part. But here's the big one that got me. Just this matter-of-fact statement that says, also, take Social Security as early as possible. If you're over 62 years of age, take Social Security as soon as you can get it. This is the expert that is being referenced in this article. Are you kidding me? That clearly tells me these people don't know what they're talking about. That's my opinion. My opinion again. They don't know what they're talking about. There's 50 some odd ways that you can take Social Security in retirement. And when you take it properly, when you really understand your options, it can literally mean hundreds of thousands of dollars of additional income over your lifetime. You have to be positioned correctly with all of your assets and all of your income plans positioned correctly to maximize every one of them. And Social Security is huge. It is a huge benefit that most people dismiss. Oh, it's not even going to be there when I retire. Yes, it is. Our kids will have to pay for it for us, but it will be there. So if you have not yet done a detailed, and I mean detailed, Social Security income analysis, and you want to see your own done in a way that you've never seen it before, from a perspective that you, in my opinion, you can't afford not to see it, go to personalpensionradio.com, fill out the Contact Us form, and ask for a Social Security income analysis. You'll be amazed at how much money is sitting there waiting for you to choose wisely when it comes to your Social Security choices. Because like I said, there's dozens of different ways to take your Social Security income. It's not always best to just take it at age 62. So that's the advice I want to bring to your attention. There's articles like this all the time, but that one just knocked me out of my chair. So watch out for that. Ask questions. Always ask that question. Is that right? I mean, does that make sense for me? Those are things that you should always be asking. So now, really appreciate you listening. Please share this with your friends. Have you heard Personal Pension Radio? Share the podcast with them. Get on over to iTunes, leave us a great review, and keep the questions coming. Thanks again to Dan for sending in that question that we used today. And if you have a question about a specific topic or something that you've read about or something that you're worried about or that you have a question, send it in at personalpensionradio.com, and maybe we'll build a show all around your question. Thanks again for listening. Really appreciate you being here. We'll talk to you again soon.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you're there, we'd appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.